Welcome to the multi-dimensional trading video series, guys. This is video number 6. We're going to show you a live trade that we took earlier on euro dollar pair, where we put our stop loss, how we did it, how we matched it up with the DXY to have confirmation. So let's get into it. So here we are on the euro dollar pair. We entered there. We got a pretty good entry on the 1 minute on the small time frame, on the 1 minute, right? Got our stop loss right there at the highs, right above the highs, right above our entry, only for 14 points. We're on one lot. So if it went up against us, we would only be out for 14 points, which is $14, right? And the $3 commission fee. So as you can see, we're up, I think, already on this trade, $52. We have our TP down there at the lows. So what I'm showing here is that once it gets in a comfortable position, I can click that button, that red button, and put my take profit. I mean, not my take profit, but my stop loss at my entry price, which is basically moving my stop loss to break even. So I would be at 0, right? So here we are on the DXY. We can see that it's engulfing those candles, right? On the 15-minute time frame, large time frame. We can see that it's running up hard on the 1 hour as well, right? It's looked like it's engulfing. It's at the bottom of that bubble too. So we have it ran down into liquidity for a long period of time. It took out the whole bubble and then some. That's the bubble theory. We're putting this to work so we would know where we are in the market. We are close to the bottom of the market. We are at the bottom of that run because it ran through liquidity, through that big old bubble that was propping up the market. And every time it props up the market, these bubbles get popped, right? Gets popped. So big old bubble has been run through. They get popped every time. It's either a bubble to the downside or it's a bubble to the upside. But that is liquidity. That's where you will find it. And it's ideal for us to get into the bottom of the bubble. But that's liquidity. Okay. So as you can see, the price is running down pretty hard. We're at 116, 117 already. We put our take profit, our stop loss at break even at this point. Okay, we want to make sure that if the price runs back up on us, we don't even lose 14, we lose 0. That's it. So now it's basically a risk-free trade. Once that trade starts running, we know we can put our stop loss at break even, which is basically a risk-free trade at this point. So I call it the 0 stop. Because you don't lose any points. You don't lose any dollars. The only thing you would pay was commission, and that's basically a 0 stop. So we got the 0 stop on. We can see the 15-minute is strong. It had like 9 minutes left. So we know we had a strong 15-minute, right? So that's part of the multi-dimensional trading, is that we're looking at the 15-minute. We're also looking at the 1 minute, the 3 minute, the 1 hour. We're looking at the different measurements or dimensions of the market all at the same time, so we can have a great idea that we have a high probability setup. So we know we're going to continue to go because we have so much time left on our 15-minute chart. Mind you, it's 11 a.m. or it just started, the 4 hour just started at 11 our time. When that 4 hour starts, that's where all that volume comes in. Remember, we play those large time frame switches, right? The 1 hour large time frame switch, like on this DXY. The 4 hour, we get the volume that comes in on those large time frame switches. So now we have it pumping, right? we can see that maybe it would stop here for a resistance area. So we always are mindful of where resistance could be, where could a pullback happen. And remember, it's always in those areas at the lows, right? Where price kind of broke through and then it comes back to it. It's kind of like a break even area for those people. But I'm pretty sure price is going to break out because we have so much time left on that 15-minute chart. So you see our 3-minute, it's not running back up, it's flushing. We're looking at it to come into these lows right here. See where everyone kind of bunched up right there and it broke through? We're looking for it to come back and retest that area. That's where we would take our profit. We don't long the equal lows at the top of a run. The equal lows are our take profits at the top of a run, right? We do not long equal lows at the top of a run. Yes, I know equal lows are a great place to go long, but we long equal lows when we're at the bottom after the prices ran down for quite a while. So in the top of the run, we're going to use these equal lows for our take profits, not too long, not to try to switch directions and go long, because we know we have strong momentum on the 4-hour. It just switched. It's been running up all day. We're at the top of a nice run to the top. We're at the top of that. So we're going to catch a trade to the downside. Equal lows is not going to be where we find support for the price. We're looking to just take profit there instead of longing that area for a bounce. It could bounce there, sure, but we're not going to long the top of a run when the 4-hour is coming down on us. That's the part of looking at multiple dimensions and multiple measurements. If you know the 4-hour, which is a large time frame, the 4-hour, the 1-hour, the 6-hour, the 12-hour, the daily, just switched and it's coming down and you're at the top, there's no point of longing any type of bounce. It's not even necessary to look for support or equal lows to catch a bounce. Okay. Now you can see you got the DXY, which is the opposite, engulfing the 1-hour. It done ran through liquidity. It's engulfing these candles right now, engulfing on the 1-hour. There's no way I'm going to short the bottom of the dollar, because that's basically what you would be doing if you longed the euro. You would be technically shorting the dollar. And I'm not going to short the dollar after I know it's ran through liquidity on multiple time frames, on large time frames. At this point, we just want to catch the bounce on the dollar, which is us being able to go short on the euro. We put our actual trade in on the euro, but in reality, we really are trading the dollar. Right? We want to know what the DXY is doing. We want to know the dimensions of the DXY so we know exactly which way to go on the euro. We can see here DXY would probably run right into that area as a resistance, which would be break evens for people who got flushed out earlier. Right? See that nice perfect line right there? This would be break evens for people who got flushed out earlier. So we're looking for a price to run into that area and basically give them their money back. Now, again, we would not short here because we are at the bottom of a run. So we're not going to short the DXY at break evens because we're at the bottom of a run, right? Just like we're not going to long equal lows at the top of the run on euro, right? So we're just making sure that if we're at the bottom of a run, we're longing equal lows. Okay, that's how it goes. If we're at the top of a run, equal lows are our break evens. They're they're the part where we take profit. Okay. So at the bottom of the run on the Dixie, on the dollar, break evens are not where we go short here. This is where we take profit. Okay, because it could easily pump straight through that because it's run down so long. That's the nuance when it comes to break evens and equal lows or equal highs. We're looking at which side of the market are we on? Are we on the long side of the market or the short side of the market? If we're on the long side of the market, break evens are just where we take profit. Okay, if we're on the short side of the market, equal lows are just where we take profit. It's as simple as that. That's equal points of contact. It's going to be break evens for those people who got flushed out. Okay, they would be at break evens. People who thought the price was going to go up, people who bought the lows, thought they had a good price because it's been running down for hours. Okay. Now, all we're doing is waiting for it to run into our take profit area. That's all we want it to do is run down into this take profit area. If it goes back up, you see we have our zero stop on. See that profit zero. It would not have us in the negative at all. So we could lose our current profit that we have, but we would not be in the negative. We would not go into drawdown at all because we protected our position by moving our stop loss to break even. So the more we can do that, the more you would be profitable, because no matter, even if you didn't take profit on time for some reason and the price ran back up on you and did some wacky stuff, you would be stopped out at zero more or less. So that's the best part about moving our stop loss to break even, or what I like to call zero stop. Right? I say zero stop loss. It sounds cool. It makes sense. I just want my profit to be locked in, and worst comes to worst, I'm not going from being in profit to being in the negative back in the red. That doesn't make any sense. So it makes sense to protect that position as soon as it makes sense for you to protect that position at zero. Okay, so we're looking for DXY right here to break above these highs and run into that break even area. It's really bullish. It could come back down, right? We draw that red line because it could come back down and touch that area and then bounce off. But for the most part, it's too bullish. So if DXY is bullish, that means the euro is going to be bearish. It's the opposite, right? So it looks like it's going to continue to go down and flush because we have a lot of volume on the DXY. Notice we don't use volume indicators because we really understand where our volume is by looking at the dollar. That's where all the volume really is the dollar, because the euro is trading against it. So we know which direction the volume is coming from on the dollar. We know we have volume on the euro as well to the short side. And that's how we play it. And that makes the most sense. It's the simplest way to really look at it. You don't really need a bunch of different indicators. And the thing about volume is it's going to be different on multiple exchanges. So you're not even going to see the same volume across all different exchanges. One exchange might have lower volume than the other, and then it's like a misreading. But if you look at the DXY, you can't read it wrong. That is our volume indicator. We can literally see 1, 2, 3 15-minute candles pumping, about to hit break evens, go into that resistance area, heading towards those previous lows, right? Those lows that were broken, those break evens, those lows that people bought at and got screwed. Prices trying to head back there. That's where liquidity's at for them. That's where price would change hands. That's where we would take profit on the Dixie. As you can see, it's flushing. We have that volume coming in from the dollar, and that's transferring against to the euro. We're in profit, 170 something. We could wait for it to hit our take profit, but I believe we're just going to take profit here because we've seen the candle on the DXY look doji. We know it could still go that way, but once we've seen it, we just said, fuck it. Why not? We could wait for it to hit our take profit, but it's run down. It's at lows. It definitely finished and hit those lows. If you guys look at the chart, it's probably going to run down even longer than that. But at the same time, you don't have to always wait for it to hit your take profit, but you do need to set a goal. Because if you set a goal, you'll hold your trades longer. You'll make more profit. Remember, guys, this is not financial advice. This is just something that you can take, you can demo, you can try it out for yourself, get the psychology down, get the practice down. I believe anyone who really practice what we are showing you on the videos are going to be successful traders in the long run. I'm not going to tell you you're going to be successful overnight, but if you practice what we are doing, it is fairly simple. Break evens equal lows, equal highs, and we use the bubble theory to find liquidity. It is as simple as that. So the trades that we are taking are based on those simple, common sense concepts. We call it multi-dimensional trading because we are looking at multiple dimensions, right? We're looking at the measurements of time, space, and price on multiple time frames. Simple as that. Price will continue to run down into those lows because it did hit that area. However, we took our profit for the sake of this video. We're comfortable with what we did. We know that price was going to run back up just for a little bit because it always does that when it gets kind of doji. It just comes with experience, right? We know that we're going to get a little bit of a pump back, so we just took our profit there. We don't want to have to worry about it running back too much. Now, it wouldn't have mattered because we had our zero stop on, and it most likely would not have run back that far. Okay, so, but that's why we took our profit though, because we can read the candles as they kind of form and see like, okay, well, the 3 minute looked kind of doji. You go down to the 1 minute, you can see it's forming green candles to back to the north side, right? So this is how we do it. Multidimensionaltrading.com. This is our 6th video. I hope this has been informational, helpful. Video number 7, lesson number 7 will be coming soon. I will see you guys in the next one. You guys have a very good day, good holidays. Peace.